Hi everyone, Happy New Year. Welcome to this video update for the December quarter of 2023, coming to you on a beautiful winter's morning from the great state of New Jersey. The December quarter rounded out an extraordinary year characterised by stock returns that were okay for the many and extraordinary for the few. So to put some numbers around this, the median stock in the S&P 500 returned 13% in 2023, while one stock in every 8 returned 50% or more. Now, Montaka was fortunate to own many of the extraordinary performers of 2023. We continue to stick to our first principles-based approach to investment analysis and monitor for high probability long-term winners within large, attractive transformations. And we try to be ready to act at a moment's notice should stock prices move to levels that reflect significant undervaluation. And this actually happened in October when global luxury powerhouse LVMH experienced a stock price decline of nearly 30% from its peak several months prior. We had been studying this business in detail over the years, and we were patiently waiting for a stock price attractive enough for investment. So we took the opportunity to sell the Carlyle Group to fund this new investment. We've not been happy with Carlyle's management team and governance, and we believe Montaka's large continuing investments in Blackstone and KKR provide adequate exposure to the benefits we are seeing in the alternative asset management space. Beyond this, Montaka's portfolio didn't change much during the quarter. Annualized portfolio turnover remains very low by industry standards at just 26%. We continue to invest overwhelmingly towards what we call compounder businesses, which account for approximately 85% of Montaka's portfolio, and we retain a modest allocation of around 12% to what we call outlier opportunities. So we'll show you on the screen now. Here are the sector exposures of Montaka's compounders and Montaka's outliers. And of course, this chart is also printed in the quarterly letter if you'd like to review it in more detail. Now, in our quarterly letter, we walk you through 5 key areas of investment opportunity that we see. And most of Montaka's compounder investments belong to at least one of these key areas. So let me just touch on 3 of them now. One of the less obvious flywheels Montaka identified several years ago was in the business models of the leading alternative asset managers, particularly Blackstone and KKR. We observe that in the asset management industry, growth disproportionately favours the largest, biggest brand names with the longest track records. This greater scale then drives advantages in talent attraction and retention, access to deal flow, geographic and product diversification, client attraction and retention, and then of course this further drives scale, and so the flywheel continues. The alternative asset management space is undergoing a large structural transformation that we think will result in supernormal asset growth over the coming decade. And we think this growth will disproportionately favour the large leading managers. So the industry is currently at $10 trillion in aggregate, and it has significant room to grow if you think about it in the context of global stocks and bonds of more than 200 trillion, and then real estate is another 100 trillion on top of that. We think growth will continue to be driven by, number one, insurance partnerships, which represents a $30 trillion pool of assets. Number 2, retail, private wealth channels, which represents more than 80 trillion in assets. And number 3, Asian allocations to alts, which are currently running at a penetration that is literally like a quarter that of North America. So while this structural transformation of the alt space remains in its early innings, it is coming, and we think it will benefit the shareholders of Blackstone and KKR quite significantly. And of course, Montaka is a shareholder of Blackstone and KKR on your behalf. Now, it will come as little surprise to regular viewers that Montaka's portfolio is meaningfully exposed to those select businesses we assess as high probability long-term winners from the AI revolution, which remains in its infancy. So we see AI winners across 3 basic dimensions. So number 1, those that can distribute the benefits of AI to customers. So winners along this dimension will likely be dominated by those businesses with very large and privileged data sets, large embedded customer bases, and these include the likes of Microsoft, ServiceNow, Salesforce, and Spotify. Second dimension, those that can employ AI successfully to their own operations to increase productivity. Now, early winners along this dimension, of course, are businesses like Meta and Alphabet, though longer-term winners will span lots of non-tech industries as well. And then the third dimension of winners we see are those that sell like literally the compute and the related services required to run the AI-infused software applications. And of course, along this dimension, the three hyperscalers, Amazon, Microsoft, Alphabet, are the clear winners in the Western world, and Alibaba and Tencent continue to appear to be the highest probability winners in the second largest economy in the world, which of course is China. Now, after seeing some very strong stock price performances in 2023, the temptation is there for some investors to perhaps wonder if the AI thesis has already largely played out. And we would strongly caution against this view. Indeed, our research shows that for most large enterprise clients, early experimentation is definitely underway. However, large-scale rollouts of AI-infused applications hasn't even started yet. There are several financial services platforms out there today that are so mission critical, you don't need to lose sleep over whether or not the business will exist over the longer term. Now, identifying these businesses is relatively straightforward, but it is far more challenging to identify a subset of these businesses that are mispriced by the market today and materially undervalued. And we think we've currently identified two. So the first is S&P Global, which owns some of the world's largest and most valuable financial datasets and has built several important businesses on top of these advantages. One of its most valuable businesses is its ratings business, which provides credit ratings for the world's fixed income securities. Of course, this business won big from the significant bond issuance that happened around the pandemic when interest rates were very, very low and demand was pulled forward. But then, of course, when interest rates started to rise, S&P Global experienced an air pocket and demand temporarily evaporated. But having said that, while the ratings earnings are currently depressed, we think the market is not adequately reflecting the very large earnings uptick that we see over the coming years, because substantially all of the bonds that were just issued over the last 3 years ultimately need to be refinanced. So the demand for S&P's ratings is simply pent up. It is coming. And indeed, between now and 2026, S&P Global expects that a full $8 trillion in refinancing will need ratings. Now, the second mission-critical financial services platform that we believe is undervalued today is Visa, the world's largest global payments network, which probably needs little introduction. What is underappreciated about Visa is the long-term compounding effect of its relatively newer, smaller, but higher growth businesses in Visa Direct and B2B commercial payments, as well as the various services that will be attached to these over time. Now, today, most of the market is focused on Visa's large core consumer payments business, which is, of course, slowing now after a sort of booming period fueled by fiscal stimuli, very high inflation. But the longer-term contribution from Visa's newer businesses will likely be much more than the market currently expects due to their compounding effect, given their relatively higher growth rates and very large addressable markets. In closing, we are very optimistic for 2024 and beyond. We think we own some great businesses that are set to benefit from large structural transformations that are relatively untethered from aggregate GDP growth rates. The macro environment continues to have some risks, as it always does, but frankly, conditions are a lot better than they were. Interest rates will likely come down over time. Growth is hanging in there. A weakening consumer in the US is being offset by some very strong capital investments. And geopolitically, the most important relationship for the planet is that between the US and China. And right now, it's actually not too bad. So we're optimistic. On behalf of the entire Montaka team, we thank you for your ongoing patience and support, and we wish you and your families a safe and happy 2024.